Okay, let's just jump straight into the presentation. So a little bit about who we are in terms of Prime. So Prime's an advice and capital firm. We have about 150 team members that are primarily located across Melbourne, Sydney and Brisbane. As Tim said, we deliver 4 core services, so accounting and business advisory, wealth management, SMSF, advice and admin, and also capital and corporate advisory services. We also look after about $1.1 billion for our clients. Ultimately, our purpose is all around empowering our clients and our team to achieve their aspirations, and our goal is to be the leading integrated advice and capital group of the future. Next slide, please. So we're really pleased with the results for this half year. The team did a fantastic job. We've really accelerated our revenue growth over the last 4 periods to the point where we've had 31% revenue growth in this first half. 24% of that came organically and 7% from an acquisition we completed in October. So really encouraging that we're accelerating that revenue. Our underlying EBITDA was up 9%. Our operating margin was 23%, down slightly on the previous corresponding period, but we should move back towards 28% plus for the full year. EPS was impressive at plus 33%, 0.88 cents per share. Our dividends were up 40%. The interim is up to 0.7 cents per share. We've also confirmed our final dividend already at 0.8 cents per share, so our dividends continue to increase. Our debt is slightly higher than the previous corresponding period, but due only to the acquisition we completed, as I said, in October. Operating cash flow down a little bit, down 13%, as we've got a little bit more tied up in working capital as we expand that revenue pretty substantially. So a great set of results, very happy for the team and for shareholders. Next slide, please. Some other important information in terms of the half year. We continue to expand our services that we offer to our clients, our core group of clients. That includes our debt capital markets advisory. That's complementary to what we're already doing across our corporate finance, corporate advisory division. We're also expanding our wholesale client offering, particularly in the property space within our wealth division. And we've also rolled out an ESG consulting service, having gone through an ESG planning process ourselves. We saw there'd be a need for that across our broader client base. We have completed that acquisition, which was an SMSF administration business in Queensland, a B2B business, around about $3 million of revenue. This was acquired, as I said, in October, expecting a $900,000 contribution to EBITDA once the business is fully integrated. We paid $4.6 million, 70% paid up front. The 30% will be the balance in 12 months from closing. So a great business offering plenty of opportunity for us to offer more group services to that existing client base. We did also expand our facility. We now have a total facility of $20 million with Westpac. The new facility is a $10 million acquisition facility. We have started using that with the $3.2 million I referred to before for the Intello B2B SMSF acquisition. Dividends I've mentioned, I won't touch on that again. ESG, we have also rolled out, as I said, our own plan and saying to implement that, and our buyback remains in place. Next slide, please. So in terms of growth, our strategy and our values as a business, we're really growing our business in 4 key ways, with our aspiration to get to 50 million of revenue, up from 26 million in 22 to 50 million by 2025. So we're growing organically. All 4 service lines are growing, which I'll show you shortly. We've got new revenue contributors, so that people with existing client bases that want to join our business and become part of the ownership structure. New service lines, which I've touched on, to the core group of clients that we have. And acquisitions, we did our first one, as I said, first one in 6 years, and we will do more over the coming periods. Our strategy is really straightforward. Our people piece is around being the place that our staff want to be, and being owners of the business they're helping to co-create, compelling our clients to want to do more with us, so more services, and really wrapping ourselves around their total needs, simplifying our business. That's a continuous process for us to make sure that we remain focused, growing our revenue streams both organically and inorganically. And in terms of values, it's really straightforward. We celebrate this regularly in terms of being accountable, being professional, very proactive for our clients and with our team in helping to plan their careers, and most importantly, relationship focused. Next slide, please. So we're really pleased to say that we've got a fantastic level of momentum within our business across all of these 5 key metrics over the last 5 years. You're seeing underlying EBITDA continue to grow from 2 million up to 3.7 million, EPS from 1.3 cents per share to after-tax earnings, I should say, from 1.3 million to 1.7. EPS is now 0.88, dividends at 0.6, up from 0.2, and the share price has steadily increased from around about 10 cents to 23 cents. Today, I think it's about 27 cents. So we're on the right trajectory there. Next slide, please. So just a little bit more key financial information, $16 million of revenue in this half, as I said, up 31%. EBITDA of $3.7 million, and the dividends, as I've previously outlined, the interim dividend will be paid on the 31st of March. And as I said, we are confirming our final dividend of 0.8. Next slide, please. So this is a little bit of an overview here of how our business has really started to accelerate in the last 4 periods. What you'll see on the top right-hand side of this slide is that our revenue grew about 4 periods ago by 11%. It then grew by 14, 21, and 24%. So we are successfully delivering more services and advice to our client base and growing our client base. 80% of our revenue is recurring in nature, which allows us to make longer term decisions about what we do with respects to rolling out further services. Our services here across all 4 of those areas, as you will see, have grown. There's not an indicator there that isn't heading in the right direction, which gives us great confidence for the future and our target of 50 million revenue by 2025. Next slide, please. So in terms of expenses, as we have been growing our business, our biggest resource is clearly our team. Our team has actually grown by 50% over the last 12 months. So our labour cost has increased, naturally, as you would expect, now having 150 team members. Our cost of sales have increased as our revenue has increased, and that is directly related to that. And we've also got the operating expenses of the acquisition in October. That's meant that our expenses are up 29%, but we're still maintaining that growth in EBITDA, which you will see there, up 9%. Next slide, please. In terms of margins, cash flow, and net debt, our margin, as I mentioned before, has dropped to 23% from previously 28%. We do expect that to head back towards 28% over the next 6 to 12 months. There's really just simply a timing difference between having put on the resources and the revenue flowing through. The resources that have been put on the team are all revenue generators. It hasn't been additional head office cost. So it is a genuine investment for future revenue. Net debt, I've touched on, that was in actual fact lower than the previous corresponding period at 5.9 million, excluding the 3.2 million we used drawing down the facility for the acquisition. Operating cash flow is down 13%, mainly due to having a little bit more tied up in work in progress and working capital generally. Next slide, please. So in terms of our dividends, as I've mentioned, it is 0.7 cents per share for this interim, but we have a really nice shape there to our dividends. We're paying out 60%. Our target range is between 40 and 60% of reported and maintainable earnings. And we'll continue with that trajectory. And obviously with EPS growing, it means that the dividends will continue to increase as well. Next slide, please. These are some of the peers that we look at there in the bottom component of the slide. We have got Kelly Partners as probably our closest peer in terms of who we look at. They've got a substantially larger market cap than what we have, but we trade at a substantially lower multiple at about 11 times to their probably 30 times plus. Importantly, we have 45% of our business is owned by key management and staff, and any team member that is with us for 12 months, regardless of the level they come into the business, they start to earn equity on the basis of us growing the company together. It's a key part of our differentiation in terms of how we attract talent. Next slide, please. ESG is part of our future, and we want to make sure that we have profit with purpose as part of that. There are 4 key SDGs that we're looking at that we will focus in on, but that is about making sure that we are good corporate citizens and making sure we're doing the right thing for our people and the communities in which we operate and really adding value and being responsible. Next slide, please. So the outlook, and this is our final slide, the outlook for the future is positive. That 5-year trajectory we expect to continue. We are focused on making sure our revenue is up at least 20% for the full year. Underlying EBITDA up between 5 and 10%. EPS growth plus 15%. We have a number of acquisitions we're also looking at over the course of the next 3 to 6 months. Dividends will continue to increase. Net debt to underlying EBITDA will be back in the target range of 0.5 to 1 times underlying EBITDA by the end of the financial year. We will continue to encourage ownership in our business by our team. And we also are continuing our buyback, which has been in place for around about a year and a half now. That's Prime in 10 minutes. Over to you, Tim.
Thank you, Simon. Bang on time. A quick question. Your peers there's been a lot of acquisitions by those peers, but you've made your first acquisition in 6 years or so, I think you said. Why has there been no more M&A within the group?
Yeah, what was really important to us, Tim, was we wanted to have the right culture such that when we do acquire businesses, that we're able to offer all of our services to those clients. So we've spent the last probably 5 years resetting our culture, delivering and building those services that we want. And we think that our culture is a really nice space now to do multiple things for our ideal clients. So now when we do an acquisition, it tucks in far more neatly than what it may have done in the past. And it allows us to make that a more valuable acquisition than simply what that business might currently do now, and adding a little bit to the bottom line. We really want to make sure we offer all of our services to all of the audience that we have available to us. So it's been a very specific approach, but now we're set for that. We feel comfortable we can be more M&A focused into the future.
And you just touched on the M&A kind of criteria. What is that? Is it the ability to sell services back to who you acquire?
So it starts with the talent within the business that we're actually acquiring, and making sure that it's complementary to what it is that we want to offer to our clients. And typically we will want to see the 1 and 1 equaling 3. And by that I mean you do want to be able to offer more to that existing client base, or you want to allow that to help you grow at a faster rate than what you might otherwise be able to. So as an example, with the SMSF B2B business that we were privileged to acquire, we've got a great team, but it's a business that actually provides services to 130 financial advice firms throughout the country, and they're SMSF services. We believe there are other things in our stack that we can offer to those businesses and help them on their journey to grow their earnings as well. So it was a very specific reason we undertook that transaction.
And in regards to capital management, you mentioned dividend and a buyback, but there's also some debt, some new debt on the balance sheet. How do you balance that, the ability to pay dividends, buy back your shares, and also have debt and pay back debt?
So it starts with maintaining that range where we want to stay between 0.5 and 1 times underlying EBITDA. So that's the first criteria. You also want to be consistent and make sure that your dividends continue to rise. So there's a balance there to make sure that that is a priority as well. And you don't undertake M&A to stretch your balance sheet. You make sure that you've got good, solid operating cash flow to fund some of those transactions. And wherever we can, we'll continue to buy back shares as well. So you balance it, you prioritise those key things, and clearly we want to remain very prudent.
And Simon, there's some attractive margins, albeit I think your margin's around 23%, a little bit lower than previous corresponding period. But I mean, financial advice doesn't have great margins. Where do your actual margins come from within the business, within the divisions?
Yeah, look, so you're right. The sort of the financial advice piece is probably not as profitable as what it once was. But that being said, it's still operating at around about that 23%. So our margin will bubble around depending on what stage a new service line might be at. But broadly speaking, you can see anywhere up to 40% operating margin within capital and corporate advisory, albeit that's more transactional. Our accounting division can make anywhere between 30 and 35%. Our SMSF division, as it's now matured into its 4th and 5th year, is now making about 20 to 25%. And as I said, wealth can be between that 20 and 25% as well. So, all of those divisions are profitable, but in the early stages of development of a division, it might lose money moving into break even, and then obviously starting to get closer to our target of 30% within the first 3 to 4 years.
And so what does scale look like for you, given there's a lot of consolidation in the sector, good margins in good parts of the business? What does scale kind of look like? So
our target to double our revenue from 26 million in 22 to 50 million is a starting point, but we think that really is just genuinely the starting point. You want to build a business that's got, sort of plus 250 mil market cap. You know, we see our team growing to 200 and 300 people. You want to make sure that in the space that we want to play, that mid-market space, you've got all the capability, and we want to really occupy a space that we don't think is being occupied now. So you've got to build your team, you've got to build your revenue, you want to make sure you can continue to reinvest in the business. But yeah, we think sort of building out to a sort of 250 mil plus market cap with circa 250 to 300 staff offering all of what we do is the right sort of scale for us. But it doesn't mean doing silly transactions just to get that. It starts with the culture and the people and the ownership mindset and multiple services for the client base we want to attract.
Great. Thanks, Simon. That's all we have time for. Thanks again for being on Hidden Gems, and have a nice weekend.
Thanks, Tim. Appreciate it.